Hi, welcome to valuationpodcast.com, a podcast and video series pertaining to all things business and valuation. My name is Melissa Gragg. I'm a business valuation expert in St. Louis, Missouri. I have the pleasure to talk to Josh Lefcowitz today about estate planning and federal gift tax valuations. Josh is a partner at Cohen and Company and is also a valuation expert in Pittsburgh, Pennsylvania. Welcome, Josh. How are you?
I'm doing well, Melissa. How are you?
Good. A lot of times, one of the questions that people ask is, or when the attorney or CPA get involved, they ask about valuation discounts, and so maybe tell business owners why these become really important.
Sure. So they become really important because they can be really significant, frankly. We see there's a variety of layers of discounting. Okay. There are, and I'll just name, the three primary that we focus on. Discount for lack of control. Okay. So when we're talking about a non-controlling ownership interest, it could be minority, it could be non-controlling because it has no voting rights. It could be non-controlling because it's a 50% ownership interest. Those are all different. They all look different, but they all likely have some element of a discount for lack of control. The next discount that we often see along those same lines, but a little bit different, is a discount for lack of voting rights. We've talked about this a little bit. If we do a recapitalization where what we're gifting or transferring are non-voting units, that's different than voting units. Even if, let's say you have two gifts, one is a 10% non-voting interest, and one there is no differentiation between voting and non-voting. It's just all the same, and we're going to gift 10%. Those are a little bit different, right? The discount for lack of voting rights isn't huge, but it is meaningful. It's usually going to be in like a 2 to 8% range, or generally what we see in the studies that are out there. And then the last one, which can be very substantial, is what's called a discount for lack of marketability. And this deals with the fact that what you own is an ownership interest in a closely held business that is not marketable. It's not sold on any exchange. There's no active market for it. Oftentimes, we'll see shareholder agreements or operating agreements that are very restrictive on how the person can actually exit those shares. The IRS does not recognize what they call family attribution. So the fact that it's a bunch of family members that own it and you're gifting it to another family member, the IRS doesn't look at it in that fashion. They look at it as a hypothetical buyer and a hypothetical seller. And so it would be as if the way I usually explain it to clients, and I think about it even for myself, is imagine I'm buying into your family business. And how am I thinking about that transaction? And so that lack of marketability can be very substantial. There's rigorous analysis that needs to be done. The IRS has won many times when that rigorous analysis is not out there. So I'm sure, Melissa, you get the same calls that I do of what do discounts look like these days and what's a reasonable discount to think about. And you can answer that question generally in the abstract, but in doing an analysis for a client, you need to have some analysis behind what you're doing. But at the end of the day, like I said, these discounts can be very substantial. I mean, there have been recent cases out there where we see discounts in the aggregate of 70%. That's not normal, but those exist. Right. You're usually going to see discounts in the 25-30% range. That's a very substantial discount. If you're talking about a business that's worth $20 million and you take a 25% combined discount on that, that's $5 million of value evaporated. So it's very significant. It's been a fight for a long time. The IRS has generally, lost, I guess I would say, that these in terms of the existence of these discounts. It's
Right.
widely accepted that they can be taken. And so, they're substantial. That's really the heart of the matter.
And that's part of where we come in, is to try to substantiate those discounts. But also that's why attorneys get involved in this, is because we need to be able to see some of those restrictions in selling it, restrictions in voting, restrictions in control, to substantiate those discounts. And so you kind of you have to have all the pieces in play. If you're just doing it to kind of act like you're moving or transferring ownership, it's not gonna work.
Right.
Or you're taking a risk that the IRS is not going to be okay with it.